the U.S. GDP expanded by 2.5% in the first 3 months of the year. That was less than the 3.1% pace that forecasters had expected. And joining Phil and I with more on this is Ed Butowsky. He's the managing partner of Chapwood Capital Investment Management. Ed, thanks for joining us again. Let's get straight into this. Is this number reflective of Washington's impact on the economy? Is this telling us that the deficit-cutting moves, including that 2% payroll tax hike that kicked in January, and the ongoing federal budget cutting with the sequestration, is beginning to now take a bite out of growth?
Well, I got to tell you, sequestration is not doing anything. All that is a cut in the rate of growth. So I want to make sure that's very clear. And another thing about the GDP number, I actually think that's a little higher than it should be, because GDP, if you really study it, it's actually a big part of that measure has to do with inflation. And that inflation number has been relatively low. Things are not great in the United States without any question, and GDP growth is very slow, and the 2.5% is far from what this country needs. We need to be up around 4% to get us out of this stagflation that we're in right now.
Well, what is going to drive us up to that 4%? We did see on the upside that consumer spending, which is a big driver of U.S. economic growth, more than 70%, increased at 3.2%. So that's the good news. It was the highest in over 2 years. But the bad news is that households cut back on saving to fund their purchases after incomes dropped at a 5% rate for the first quarter. So we've got lower incomes and lower savings. So that's a bad sign for future spending growth, right?
Yeah, I mean, I always want to be very real, and being part of, being very real, you also have to explain that a lot of that consumer spending had a lot to do with rising fuel prices, because as prices rose, people had to spend more money. So, not to, again, to, paint an unrealistic picture. Things aren't great. We can sit here and pierce all these different numbers. What has to happen? We have to find a reason to create demand in this country for people to want to go out and spend a lot more money. And we're not getting that because we have a lot of, basically a lack of clarity, Michelle, in the economy, a lack of clarity on future business. And because of that, people develop inherent inertia and they don't do as much as they would like to. The spending on housing, that's fantastic. I mean, I'm happy to see that because a lot of people think that's a leading driver of the economy. I'd like to see our GDP number higher, and that unemployment number is the one that's killing us right now. We got to get more people to work.
Now, the Federal Reserve has been pumping tons of money into the economy.
Yeah.
Has it been helping? We know it's certainly been helping markets, and I want to bring Phil in here on this question. The Fed's been helping boost the markets. Has it been helping the economy? Is there a disconnect? I know, Phil, you want to follow up on this.
No, Ed, please go ahead and talk about how the economy is helping individuals.
Yeah, I mean, here, the printing of money, the goal for every single country, you're seeing it in Japan, you're seeing it, all throughout, Europe, and you're seeing it here in the United States, is the printing of money devalues the currency of each one of these countries. It's almost a race to the bottom, but you see that devaluation of that currency, and the hope there is that it will stimulate our exports. That also didn't happen too much in this country. So the printing of money, people think is stimulating the economy, but less than 10% of that money that's being printed is actually being loaned out through those banks. So it could happen down the road, and we might start seeing much higher, government inflation rates, although I think the prices are going up dramatically if you look at each item separately, and I think that's having somewhat of a negative impact. So the sum total of this, Phil and Michelle, is I do not believe that the printing of money is doing an awful lot to stimulate the economy, because the numbers don't really support that the economy is recovering.
Ed,
yes,
I want to ask you, you've pointed out some negatives and some concerns you've had about the economy, but let's think about the folks, for example, just in our little circle here, those that are still working. They're waiting for retirement. They've watched this market. The S&P 500 has nearly doubled. Their 401ks got slaughtered, and they got burned by the marketplace over the last 5 years, and they're watching this market hit basically new highs. They're saying, well, what do we do now?
Well, first of all, you should, at this point, I actually wrote an article today saying to pull back about 20 to 30% of your holdings in equities. I've been fully invested. I'm starting to see some reasons right now that earnings are starting to get hurt because top line revenues are not coming in and they're not rising. Earnings are okay, but top line revenues aren't. But people should stay fully invested because they should have a very long-term perspective on the market. And I think stocks will continue to go higher because they're about 20% undervalued right now, Phil. It's a great question, and people should stay fully invested.
Remember what got us into this mess? The housing, the banks. They were blown up 4 or 5 years ago. Well, now they're coming roaring back. We've seen relatively good news from the housing market. The banks seem to be a little bit more stable. Are things good enough that the average retail investor can say, hey, I'm going to put my toe back into the water. I want to get invested back into the marketplace. And what sectors should they look at?
Well, there's no question. I mean, things have been okay for a number of years, and the market blew up. Yes, because of housing, but more importantly, because of leverage that was used as a result of these loans. But should the retail investor get invested? Of course they should. What sectors? They should be looking at utility stocks. It's one of my favorite sectors. I think that it has some downside protection, and I'd really overweight utilities because you get a nice dividend, about 4.5% income off of, generally speaking, utilities in the United States, and you probably will see some growth. So I like the total return of utilities very, very much. I really like utilities a lot.
All right, I got it. You like utilities, Ed. Thank you very much. Ed Butowsky joining us from Dallas, Chapwood. Michelle, thank you in New York.